Hi everyone, and welcome to our webinar, When the Government Lifeline Ends. This is Charles Hoy, Business Development Director of Prescient Models and Deep Future Analytics. It's my pleasure to introduce Dr. Joseph Breeden. He's the CEO of Prescient Models and Deep Future Analytics and the President of the Model Risk Managers International Association. Joe has written over 50 books and trade publication articles, including Reinventing Retail and Analytics, and 2 books on CECL. Dr. Breeden created numerous financial models during the Mexican peso crisis, the Asian economic crisis, the 2001 global recession, the Hong Kong SARS recession, the U.S. mortgage crisis, and the global financial crisis. These crises have provided Dr. Breeden with a rare perspective on crisis management and the analytic needs of executives during these particularly extraordinary times that we are currently in. We encourage your questions and discussions during the webinar. Here's Joe.
Thank you, Charles. And I think for our next webinar, we'll shorten that introduction. I know that most of you know who I am, and but I appreciate it. As we go through this, please feel free to ask questions or send questions via chat. I won't be offended. In fact, I'm much better with a live audience than I am monologue. So please join in, since this is what live audience goes for these days. Today, I want to talk about the current environment, and anything you do these days, you've got to put a date on it. Exactly what day were you making these comments? I worry that someone will go back to a webinar I gave 4 months ago, and who knows what I got right and I got wrong, because things change so fast. And we are in an environment where, you know, it's more difficult to predict what's coming than any environment I've seen in my career. Certain general patterns we can anticipate, but so much is driven by policy and public behavior and things that we haven't seen these situations before. So in any case, as of today, this is what we think we know. These are the scenarios that we have plausibly for the future. We'll look at impacts on loss forecasts and what this all means relative to the models we have. And then I'll finish up with new origination strategies in light of all this, because there are still loans to be made, and what can we say about new loans as compared to the ones already on the books. So for the current environment, as I said, there's new information every day. Of course, tracking the virus is important. This is an unusual situation, because if you just think about things economically, past recessions, you could look at prior recessions and get some. So to understand the situation we're in, it's this combination of the dynamics of the economy and the dynamics of the disease. And so in any talk I give, I have to start with where are we with this disease? And the lags are important to consider. I saw some commentary back right after Memorial Day, maybe about 2 weeks after Memorial Day, where people said, hey, it's been 14 days, we don't see any increase in reported cases since Memorial Day, everything is fine. Well, exponential growth doesn't work that way. If we have a 14-day doubling and I start from 10 to 20, it takes a while before we get up to large numbers. And so the increase we're seeing now is probably the exponential growth from Memorial Day, from opening up through the summer, and even July 4th. The increases you're seeing here won't reflect transmission largely that's happened over the July 4th holidays. So this is a very long delay kind of system. And in fact, and so in a situation like that is very hard to manage. In fact, there are studies that have shown that this is what humans are worst at managing, our systems with these long delays. And not only do we have a long delay between action and the response in terms of reported cases, but there's another 3-week delay between reported cases and fatalities. So we can see fatalities increasing. I'm not trying to be pessimistic by putting that dashed line. I'm just trying to say, with the increased cases we've already seen, this is baked in. We will have more deaths. The percentage of fatalities is lower than it was in the beginning. This is also understood that the most susceptible will be the ones who succumb earliest in this pandemic. The ones who come later, the fatality rate will be lower. But it doesn't mean that it's not going to happen. So we are facing at least 3 more weeks of increasing fatalities. One thing that's also clear is that a lot of states, a lot of just the public in general, wanted to get back to normal life. And as long as the virus is circulating, we can't have the kind of normal life we had beforehand. It has to, the only thing that will work is a new normal where people take personal responsibility. So the shape of the recovery, we tried to force a V through whether you want to look at government policy or just public behavior. We tried to get this V-shaped recovery of life just goes back to normal. But that's actually the best way to create the W, which was the worst case, that if you try too hard to go back to life as it was, you wind up with this hard bounce. And unfortunately, it is looking a lot like that hard bounce right now. Now, I've mentioned a couple times already public behavior. In the early presentations I made, I talked a lot about policy, what we can do economically to support consumers, what we can do through health policies to try to prevent the disease. But no matter what policy we set, it comes down to individual responsibility. Most countries in the world, the countries who have been successful through the public listening and taking responsibility. So you can call it civic duty or social responsibility or whatever term you like. But that's how we get this under control, is through individual actions. And, you know, what can we do to get people to take this seriously? We're still not. We're not managing this very well when you look at people one by one. In fact, I'll tell you, very quickly, I spoke to my daughters, and they said that the week prior to the July 4th holiday, they both live in Los Angeles, and they got a bunch of party invitations for big house parties. They're both in the early 20s. I'm assuming these house parties were largely 20-somethings having big parties. And my daughter said no, but they got a lot of blowback from that, from their friends who were upset with them for not just, come on, it'll be fine. And that's it's discouraging to see that that's the attitude people are taking. So there are a lot of other anecdotes that I could go into, but we know that this is the problem right now. So where is the virus? To be fair, it's everywhere. It's almost everywhere. In the beginning, it hit major cities first, transport hubs. We knew it would. And so the fact that New York and San Francisco and Los Angeles were some of the early ones to be hit by this was no surprise. You can see Louisiana on here had 2 humps because they had tourism and Mardi Gras and things like that, which caused that initial spike. So it's obvious where it started, but it was never going to stay there. The virus is spreading to small towns, to countrysides, to every country around the world. So I'm showing a graphic right now that the New York Times has some nice graphics here, and these are 42 states and provinces where the virus is increasing. There are another 5 or so where it's flat. There are only a few states where it's continuing to decline, and those seem to be all up in the Northeast where they're taking a lot of social responsibility, it seems. So what does this mean economically? One site that I've been looking at somewhat regularly is Womply. You know, I'm not advertising for them. Mostly I'm mentioning this because there are lots of companies out there offering new data sets that haven't existed before, new ways of looking what's going on in the economy. And I think that's important. What you see here is just one sample of the data that's available, and this is looking at total spending at local restaurants. Compared to the pre-crisis average, you can see that initial plunge, which was a 85% decrease at its worst. And then we had the long, steady recovery, but too much, to be honest. It appears that back around mid-June is where we hit our peak. And since then, there's been a decline. Now, I checked this morning, and there's an additional spike in here for the July 4th weekend, a spike up. So when you look at all sorts of sales, you'll find that initial spike. But I would get as soon as the new data is released, they've got a 2-week lag on their public releases here on this data, that you would see a continued decline again because we've had to close up again. So the red line is my own, just trying to highlight this overall trend that, you know, this is complicated. This is not going to come easily. I want to compare this graph to the kind of data we get from FRED, the classic economic data sets that are updated monthly or quarterly, and they go back a couple of decades. The graph on the left is the kind that we fit our models against, which in normal times seems fine. Even a normal recession, recessions build over time, and you tend to fall into them over a number of months. Not like the one we're dealing with now. So that graph on the left doesn't have near the resolution or information content as the one on the right. And unfortunately, the normal official economic data, as soon as it comes out, is out of date compared to what's really happening. Unemployment rate, when we're talking about lending, unemployment rate is clearly the most important metric we look at. And there are a lot of problems with it right now. First of all, the most recent unemployment rate number we have was for the month of June, but it was really a survey based on the first 2 weeks of June. And so it doesn't capture what happened later in June, and it doesn't capture what's happening now, of course. So when that number was released and it showed a big growth in new jobs and a fall in the unemployment rate, in the same week, almost the same day as we're getting good news on unemployment, we're getting the bad news on rising caseloads for the virus and having to start shutting down again. So we know that this is overly optimistic, that this is not what's really happening. Now, most of you have probably already heard that this unemployment data is not correct. The Bureau of Labor Statistics has been putting out release notes where they indicate themselves the numbers are not right. They don't change the numbers that are reported from the field, but we know what's happening is that the field staff, in doing their interviews, has incorrectly classified some people as absent from work when they should be called temporarily unemployed. And you know, it seems like a simple thing to correct, but I have no concept of how hard it is to retrain field staff. They've been trying over the period of about 3 months now. They're getting that resolved slowly, but they're still out of alignment. So the worst case, economists were predicting that we'd hit a peak unemployment rate of 20% based on just looking at initial claims and all these other things. And in fact, if you adjust this for those who were misclassified, it would have been 19.6. So the red line here is the adjustment capturing the misclassification. The blue line is the official number. Now, as a model developer, in the future, when we download this data, unemployment rate will still be the wrong number. BLS is not going to change it. That's not what they do. And the Fed is going to keep putting out their CCAR and DFAST scenarios for stress testing that's going to have the incorrect number, which means almost everybody in our field is going to be building models off the incorrect number, which means we're going to lose the fact that this recession was worse than these numbers show. And it's a challenge. I want to point this out relative to unemployment rate because it's true of much of our data. A lot of our data has reporting errors, reporting lags, and in the future it's going to be a challenge to figure out how to use this data in running the models and in refreshing the models. Let's look at some other effects that are occurring though. Deposits have seen a dramatic rise. This is looking at the year-over-year percentage change, and in the first half of this year, we're getting a 20% year-over-year increase in deposits, which is the biggest. I looked at the longer series, and I think that's the largest increase since 1960 when this was available. So dramatic growth in deposits at the same time that we're worried about increasing delinquency, and it's just a phenomenon of hoarding cash. Anybody who can hoard cash is doing so. So it creates a really unusual dynamic. We haven't seen rising levels of missed payments at the same time we're seeing rising levels of deposits like this. Commercial real estate values, we've all been worried about. There's nothing surprising here. Again, I'm using another alternate source. In fact, I'm trying to make sure that all of them give credit back to the original sources. Most of these are screenshots. I'm not trying to capture data and rebuild graphs because I want you to see where they come from. And this is another case where commercial real estate prices from Fred or the usual sources is pretty delayed. It's often quarterly and it's often reported after a long delay. Some of these alternate sources are much more frequent, but with shorter history available. So what you can see so far is that commercial real estate property values are declining, but they haven't declined as much as they did in the last recession. There's still plenty of room to go down and still just look like a normal recession. I think the risk here is that it goes down and doesn't come back up anytime soon. I'm sure many of you on the call have had the same conversations about what does your future look like for your office. And there are many articles out there about companies not renewing leases. Apparently WeWork had a wave of non-renewals back in the first 2 months of the crisis. Now they're getting a wave of new leases from companies that don't want to re-up their current lease, and they just want some temporary flex space. And a lot of people are reporting that they may not be going back to the office in the long term because it's not required. In fact, I have a friend who works in Manhattan, is living in New Jersey, and so throughout the crisis so far, he's been working from his apartment at home with his wife and his kids. And he said he's miserable. He basically can't go out. There are no benefits to living in a big city there. He was always the guy who said everybody had to come to the office if he made it to the office, but now he's saying, why do I live here? I might as well live somewhere else and let my team live somewhere else. We'll all work from home in a pleasant setting. So there are obviously lots of pressures on the value of commercial property, whether it's retail or office space. And every major crisis, whether it's a war or looking back at other dramatic natural disasters, every major crisis brings social change. And it's clear that there will be long-term social change in how we live and how densely we try to live and just how much commercial real estate we need. So there's no doubt this has more room to go down. And if I was just drawing a scenario by hand, I'd say it could be down for a while. Now, let me check a question. There's a question here, someone who didn't give their name, that's okay. But it says, given that the data in respect to the pandemic will be a shock event, how would we deal with it in respect of time series? We could treat it as an outlier and ignore it, but this obviously removes the causative factor in the obviously increased default rates. So that is an excellent question and a key one. I think we won't really know until we get further into this. In fact, a lot of this presentation is about when are we into a normal recovery instead of just the shock. And so a normal recovery means that economic principles are at play and we're not just being driven by government assistance and forbearance, but you're into the quote normal process of new businesses being formed and people looking for new jobs and all of that. That recovery process will be valuable data. I think the most troubling data is during the government assistance and forbearance periods. But I do think there could be value in this data from a time series perspective, because in the last recession, which was, we thought that was bad at the time. It was. And in response to a particularly bad recession, the government reacted. It changed withholding taxes on paychecks. I probably used the wrong word there, but a number of things were changed related to unemployment benefits, extending benefits out to 99 weeks to try to give people a chance to find new jobs, to get through the worst of the recession. And so we saw how much government response you got to a recession of that magnitude, and you've already baked that into your models. Your models are not linear. They're already capturing that the more bad the recession is, the more the government will intervene. So along that scale, this is another data point of how much is government willing to intervene given the severity of a certain crisis. So there's an argument that we may want that in there because government will always intervene in the face of a dramatic recession like this. It probably won't always do the same thing. Hopefully we'll learn and keep finding better things to do. But there will always be something. And so I think the more severe the event, the more intervention we're going to get. And it's appropriate for the models to learn that, at least in average. The model will never get it right because the policies will never be the same as they were the last time. But at least it gives you this sense of the boundaries, the limiting effect of how much unemployment can we live with? What do we do as unemployment gets higher and higher? So, good question. Okay, some more data to consider. There are several measures of housing distress, and here are two. The one on the left, Black Knight Mortgage Monitor, is looking specifically at delinquency rate on first lien mortgages. And of course, here you've got that dramatic spike just in a couple of months, getting up to 7.8% mortgage delinquency. Which is 2/3 of the way up to the worst point of the last recession. So that's bad. But on the right, another group, Apartment List, based on a survey, they're just asking people looking at both mortgage and rent, any housing payment, did you miss your payment? And so the red part is the consumer didn't make a payment at all. The lighter shade is that they were late in their payment. And so you can see in the most recent month of July, that's 32% of people who were late with their payments or missed payments. And that's while we still have government assistance. And this is while we still have a certain amount of renters support, meaning, at least for those who there are certain conditions on it. It covers about a quarter of all renters that they can't be evicted. And certain cities have moratoria on evictions. So, there are a lot of uncertainties here because at the end of the month, a lot of things expire and some of these eviction moratoria will expire. And we don't know what happens next, but that's a lot of people at risk. So, lots of uncertainty. Here's some data on auto loan forbearance. And the impact of forbearance is very dramatic. So this is from the Fitch Ratings ABS Index, and Wolf Street compiled this. what they're drawing here in the green and blue lines are year-over-year comparisons. So same month prior year, and you can see that in April, auto delinquencies were rising dramatically. This graph is showing the percentage of auto loans that are 60 plus delinquent. And so in April, it was up above 5%. In June, it drops down below 4%. That's not because all these loans suddenly got better. It's because of the forbearance programs, that they weren't counted in the ABS data as delinquent anymore if they entered a forbearance program. So this is another case where the data may not mean what we think it means, because being in forbearance doesn't mean that you're out of the woods. So that is a lot of data that's all over the place. The economy is clearly not as bad off as it was back in late first quarter when we had almost a complete shutdown. But we're definitely in a rough patch because we're having to reclose, we're having to rethink how to do this. And you could see the decline I showed in restaurant sales, that was before some states started closing restaurants. That was simply consumer fear. And this is what we've been worried about, that as case counts go up, consumers become afraid, and no matter what government does, consumers stop going out and participating in the economy. So there is no separate discussion of economics or epidemiology here, that fighting the disease, making people feel safe, and growing the economy are all intricately interconnected. They are one and the same. So the scenarios for the future are really about how to make people safe and how to make them feel safe, and what's going to happen in that regard. So let's look at this. Since the last time I talked, the Fed has released their COVID-19 stress scenarios. And so I've copied another graph with attribution. This comes out of the Fed document on their release. They reported a few of their economic variables for their scenarios, but not all of them. So this is the one for unemployment, showing the green dashed line on here is what their severe scenario looked like. And this is, even the Fed recession scenarios always happen faster than, usually we would say they happen faster than real recessions do. But here you can see it's quite a bit slower than the event that we're dealing with. This event is higher and more sharp. The V and the U are pretty clearly, they're pretty easy to understand. The V was an assumption that things got bad, they'll get better, back to a good level, and then we work out the problems from there. Well, I think I consider it highly likely that we're not going to be on the V by the time the next unemployment numbers come out with what's happening now. Unless, again, it's only based on surveys of the first 2 weeks of July, and we won't see the impact of all these reclosures through the last parts of July. So again, that unemployment data is very suspect. The U assumes that it takes a while to work our way out of this. The W is what happens when you try hard to create a V, but you get a hard bounce back. And honestly, the risk of a W is much greater than it was before. Now, these are national scenarios, and what's clear is that we're not going to be as coordinated across states from now on as we were in the beginning. So this sharp, dramatic W scenario may not be what happens. It may just be a long sag from where we are now, that some states are still getting better, a few, some are flat, a few, many are getting worse. There'll be different responses to all that. And we'll see how all this plays out, but it's like taking an ensemble average across all these states. It's probably not going to be as coordinated. It probably won't be as sharp. It may just play out to a long, slow sag. So we will see. Given these scenarios, the Fed ran their own stress tests, on the 33 CCAR banks and made a few changes. Overall, they said the banks are well capitalized, and that's what we expect. Between CECL loss reserves and capital reserves from the CCAR and DFAST process, banks are pretty liquid these days. And so all they recommended was prohibit most forms of share repurchases, put a cap on the growth of dividends, and impose a limit not to exceed recent income, require them to reassess their capital needs and resubmit plans later in the year, which only makes sense because things are happening very fast, and conduct additional stress test analysis later in the year. In fact, I expect most of these banks are doing this monthly. I would hope they are. So in any case, this is what the Fed's analysis showed. And I didn't show our graph of V, U, and W scenarios because it looks identical. I was kind of amused. I was all ready to put out some new scenarios for our clients based on the scenario AI service that we have. But the Fed scenarios are so similar to the ones we're already running, there was no point. Basically, this scenario AI service is just, it's a deep learning, it's an ensemble of deep learning neural networks that are trained on prior patterns, and we can fill in the variables that are missing. So if you have a scenario for unemployment and GDP, like what the Fed provided, then we can solve for the rest. And so that's what we've been doing. And this notion of V, U, and W scenarios, the reason ours look so much like the Fed is that the logic is obvious. It's very clear what it means to have a W recession or a V recession. Now, we've been running these V, U, and W recession scenarios for at least a couple of months now, refreshing them every 2 weeks. I'm beginning to feel like we're going to have to introduce the L scenario. I was hoping that W is the worst, but you know, to be really frank, if certain groups don't start taking more personal responsibility and cutting back on house parties and things like that, we're not going to get this under control, and we're increasing the risk of the L, or the Nike swoosh that just lags for a long time. So we're probably going to have to expand our alphabet here, unfortunately. So given that, and I suppose it's incumbent on me to say, we do sell those scenarios. So if you want a cheap, rapidly refreshed source of DFAST variables scenarios for those, they're available. But I want to focus now on the impacts on loss forecasts. And I think a lot of people need to hear how models work. Now, the audience I'm talking to, there's a large percentage who are modelers. So this will be fairly clear. But I've given a lot of interviews so far this year, and many people have. And a question I get a lot is about the models being broken. I think it's fair to say the models are not broken. Models are pattern recognizers, and that's all they do. You can't model what you haven't seen before, and so this event is unlike anything we've ever seen before. So the model is not going to be able to predict this kind of event. And I should say, there's no point in rushing out and building new models right now because you don't have any training data. You don't know the outcome. You can see consumer distress and economic distress, but you don't know what the final defaults and deposits and attrition and everything else is going to be. We won't know this until we're well into the recovery. So there's no new data to model on, and there's no past equivalent event to model on. I built models on the Hong Kong SARS recession back in 2002, 2003, but that's not a good proxy for what the U.S. is dealing with now. That data might be informative if you're in Germany, where the caseloads are orders of magnitude lower, but not for us. So this is a case where the models are working in the sense that they are showing us based on past patterns what losses would be if we hadn't done anything. If government response had been no more than last time, if the government had simply said, yeah, we're going to increase unemployment duration, unemployment benefits duration, And yeah, we'll give you some tax breaks. That's what we did last time. The models kind of bake that in. And so when we run our models based on what's happening, we get very big numbers because the models don't know about the government assistance and the levels of forbearance, and because of all this, the comparatively small rise in losses. But by telling you what could have happened, they create a boundary condition for us. And they tell us how many people are at risk. So it's equivalent to saying, when the assistance ends, the government assistance, the forbearance, when these things end, where could we be? And that boundary, what looks like a boundary today, could be the reality as soon as those things end. So this is the point of this talk, and that's what I want to go into, is how do we use that information? How do we use those models? Now, I think a good variable to track right now is real disposable personal income. This is a graph of year-over-year change. And again, we're experiencing a dramatic spike in this, bigger than what we've seen through many recessions, but I'm focused just on comparing to the last one. You get this initial spike up, and that is because of checks in the mail, and also because of additional unemployment benefits and other programs. It's not the only thing. It drops back down because the checks are spent. There's no second check at this point. What happens next is the question. Where does income, consumer disposable income, go? So what we've been doing is looking at creating overlays. Now, overlays is a generic term. I was corrected yesterday that what we're really doing is making underlays, which I think that's an amusing word. That with the loss forecast as an upper bound, what we're really saying is that we need to reduce our estimates by some amount. And so the way we're looking at this is, let's assume the government doesn't let all these benefits end at the end of this month. I mean, just to be honest about it, it's an election year. I would be shocked if they don't extend through at least November. And in most election years, when you've got a sensitive policy issue, a can that they need to kick down the road, they go down to December. They want to get you through the election cycle so that the next Congress can deal with it. So I would be surprised if we didn't see an extension of some sort. Now, it's not going to be identical to the last one. The last one was a rush job, and there are a lot of complaints about it. And so the next assistance program probably is going to have more fine-tuning, and it's going to be adjusted in various ways. I don't know if the net benefit to consumers is going to be a continuation of where we are, but let's just assume. Let's assume there is another check in the mail so that we stay at that best level and we stay there through a certain amount of time. The goal of government assistance, the theory or the wish, the hope of government assistance is that it's a bridge that gets you from a bad situation. This assistance came in right at the same moment that unemployment rate was spiking. We want it to carry us from that point to some future point where there are more jobs available. We want to jump across this gap. And the idea was, if you can just freeze everybody's employment status, all the companies are frozen in place for a certain number of months, and really this program was ideal for a V-shaped scenario. That's kind of what the initial design was hoping for. Then you'd say, as soon as those benefits run out, we'll just reopen the businesses and everybody goes back to work because the disease will have been conquered. Well, of course, that's not likely. That's why we have these three different scenarios. So the idea would be, when these benefits run out, let's look at which scenario we are on. We hope that it's better than where we were. And so it's really the distance between these two. If I look at the gray line is that U-shaped recovery, if that's most likely to be real, well, instead of a real unemployment rate of close to 20%, I would be down to an unemployment rate of more like 14% if government benefits ran out where I've drawn this dashed line. That's not bad. So maybe those people that would have been unemployed wouldn't really be. The delta here are people who we hope kept their jobs and therefore go back to getting caught up on payments and things like that. So we want to look at this in these different epochs. The losses we hope were avoided here, the losses that will come back once reality returns to our scenarios here, and a certain hangover. Some of the losses through forbearance that didn't happen here, but they may happen in the future. So we can break this down. Relative to the forecasted losses during that period, what we've done is to say the gray line here is the modeled loss. This is an actual example of a stress test of not a client, but using call report data, public data. So here are the losses that this financial institution would have incurred. But because of assistance, there's been deferral. The red line down here, the negative numbers, are how much of this was avoided through assistance. So it didn't happen now as predicted. But there is still some loss happening, and this is a dial. What fraction of the forecasted losses are going to go ahead and happen? And this is up to your policies. Do you give forbearance to everybody, push all losses out in hopes that you can catch them all up later? Or do you go through a selection process and say, if they were in distress before all this happened, if they lost their job before the onset of the crisis, well, that's not coming back. If they're lost their job in a company that has closed and they know they're not getting it back, you're really into recovery. You're not into a forbearance process. And so the blue line here through this forbearance period is how much loss do you let happen as opposed to trying to prevent. And then you can see after the forbearance period is this hangover effect. Some of the losses that you deferred will come back. When forbearance ends, their jobs didn't return, and you start working with them to see if you can get them through this, but some won't. And so what percent would be lost early? What percent will be lost late? And there's a certain share that you won't have back, that we collectively, government assistance, lender forbearance, all these things, manage to get them over that bridge, and they go back to being responsible consumers. And so that's the question. And you want to consider these different components of that. Now, there are also loan level considerations. You can look at this by tracking the distributions of delinquency and forbearance by segment in your portfolio, considering their conditions before the crisis and since the crisis, looking at the borrows, employment and revenue, uncertainty by industry, because we've already seen getting your job back doesn't mean you keep it, sadly. That, again, if consumers aren't responsible, if the public isn't responsible, then some businesses are forced to go back into a form of hibernation. They may not make it. We're already hearing stories about businesses who said 2 closures is too many, and they've decided to close. So there is, even those who get their job back, you have to do an assessment of their uncertainty going forward to get a handle on the cure rate. Basically, what's the forbearance cure rate? What we're seeing right now is a lot of people have taken forbearance in order to hoard cash, a strategic delinquency, a strategic forbearance. That's why one of the reasons deposits are going up. When the forbearance ends, we may see much higher cure rates than we have historically because of this strategic forbearance. But that's not everybody. There will still be plenty who can't make it through. And of course, looking at pre-crisis conditions to get an idea of the willingness to pay of the borrower. Doesn't mean they have the ability right now, but if they were trying to pay before, if they had pretty good risk ratings before, whether it's a business or an individual, that does tell you who you're dealing with. So it gives you some idea. Now I want to take this one step further and just show you a simulation. So I'm going to jump over, and I just have to bring this up and share my screen. Okay, I mentioned that we did a simulation based on some public data, call report data. In fact, you know me, I don't give much of a sales pitch during my calls, but I have to point out that we actually have this available as a product on any financial institution. We can run complete P&L stress tests based on call report data, time series models, that sort of thing. Now, I may have missed a question that came. No, I did answer this. Okay, that's an old question. What you should be seeing right now is my screen, where what we have here, all these other tabs, are call report data with different scenarios. And basically, I've set up right here the same kind of scenarios I'm talking about. I wanted to show you that based on the end of government assistance, the predicted percent of the, let me say it differently, the percent of predicted losses that are incurred during the assistance period, the percent of deferred losses that will be incurred in the future, and over what span of time are we going to have those post-deferral losses happen. And so these are just, this is trying to do a high-level overlay, and you can see as I change the assumption on when the assistance runs out, the graph on the right is changing. The solid lines are those VU and W scenarios showing the projected losses. The dashed lines are showing what happens in terms of deferral. Some losses happen now, some get deferred, and we're returning back to the model prediction with addition of some of those deferred losses. And so if politicians do what I think, then really 2021 is where we're going to be hit with most of the losses from the current event, just because of how we try to work through this. Now, this is just looking at loss, and of course, you can ask things about, let me go to my charts. You can ask this question related to balance growth, deposit growth. These things are affected by the economic scenario, expenses as well. But I wanted to look at allowances here also. You can see that this is going to have a real impact to the allowances and provisions. And the more we push out these losses, the more it's going to affect when we see these things. And in fact, if I go back and change my assumptions by a few months, you're going to see that the provisioning is going to be much more spiked for the beginning of the crisis. Now, this is an interesting effect when we talk about pro-cyclicality of loss provisions. This is somewhat under the institution's control, because if you're putting a bunch of forbearance in place, you will have to do a projection of losses. This allowance is a 12-month look forward. Of course, in CECL, you've got to do a lifetime forward look, but it is affecting your provisions, regardless of which rules you're under at the moment. Your policies will affect your expected future losses, which will affect your provisions. And of course, things like return on assets and other portfolio metrics. So just wanted to highlight some of those things. I'll go back to my slides. I will say just that if you want to see something like that on your own portfolio or on your peers, we offer that as a very affordable service. Now, back to my slides. Okay, so actually this was the slide where I was going to jump over and show you that. And yes, this is my quick marketing slide to point out that all that modeling is done at the state level, and we do it for both banks and credit unions off of call report data appropriately, running the different scenarios from Scenario AI. So I mentioned CECL briefly, and when we were doing our CECL studies for the past 2 years, we did a big mortgage study, we did a big credit card study, and in those studies, we did a retrospective run, and we showed that what you don't want to do, no matter what, is turn on CECL at the beginning of a recession, because the gap between your CECL loss reserves and your current loss reserves would be maximized. And we assumed that if there was going to be a future recession that happened to coincide with the adoption of CECL, that CECL would get delayed. But this all happened too fast. And so the worst possible way to introduce CECL is exactly what's happened. And it happened so fast that there really wasn't much they could do. They gave the option to defer adopting CECL, but only until, quote, the crisis is over. We don't know what that means. We don't know when that would be. And so some lenders have decided to defer their adoption of CECL, but they're going to have to play catch up and restate under the current offer. They're going to have to restate their recent quarters under CECL rules once they catch up. That's all just a pain. And so most people have decided they were already ready for CECL, just keep it going. So looking at the results that have been reported, the public filings, there was on average about a 30% increase with the adoption of CECL, primarily you would say due to the lifetime estimation, because on CECL day one, the economic scenarios were still basically flat. Now that's a median number, that 30%. Lenders out there, there were numbers as high as 200% change, and we understand why. Are they heavy in mortgage or other things? So a lot of stuff going on there. Day two was basically we know the recession is on us, and they added another 20%, most lenders. That 20% looks like a V-shaped scenario. And then what we're seeing now, you might call day three, the new quarterly filings. There's an extra reserve being made. Looks like it may be on average another 30%. These numbers are in line with our expectation. The graph at the right is something that we ran almost 2 months ago based on VU and W scenarios, and you can see that the V scenario is coming in somewhere around 10%, the U and the W more like 35 to almost 50%, looking across different property types. And this is a test study done across a couple hundred institutions. So, you know, it's not a surprise that the numbers are coming in the way they show. Now, the irony here is that if you're under the old rules, you are going to be more pro-cyclical. And I know that's not what you've heard in some of the press, but because CECL is a lifetime calculation, if your reasonable and supportable period is 1 year or 2 years, that means the rest of the life is based on a through the cycle average. That automatically means that CECL is less volatile than a simple 12-month forecast. Now, most people do FAS 5 with a 12-month backward-looking moving average, and then they add a Q factor adjustment. But everybody's going to have to add an adjustment right now for the fact that you're in a recession. So it's a lot of those comparisons were unfair when you'd say CECL is pro-cyclical and FAS 5 was not, because they weren't considering the Q factors. If you look at actual loss reserves through the last recession, they were also pro-cyclical. And so really, your 12-month loss forecast is about a factor of 2 higher volatility than what I'm showing in the CECL graph here. Okay, now I apologize. I'm running long, and I guess I just had a lot more to say this time than I realized. I'm going to keep going, and I'll hang around for questions later too. And so I totally understand if people need to drop off, but I want to talk about new origination strategies, because the world is not only the portfolio you currently got. This is a graph of vehicle sales, and you can see the plunge in vehicle sales with the onset of the recession, basically the shutdown. Dealers were closed like everybody else. There has been a rebound about halfway, That's still not back to where we were before, and you can see how long it took recovering from the last recession. Even this much rebound is great news. Basically, we jumped through a couple years of recovery already, but I don't expect that to keep, we're not going to get back to where we were in just a couple of months. We're going to start following a more normal recovery path. But the good news here is that rebounding halfway, that's still, there are still loans out there to be had. And so what this means is that the kind of loans being originated today are not the same as the kind of loans you would have originated pre-crisis. They're not the same borrowers, and we'll talk more about that too, but I also want to show existing home sales. Now, existing home sales are down about a third compared to what they were pre-crisis. They are, they're not in the heady days before the last recession because that was a bubble. There was a lot going on there that really shouldn't have been. But compared to a normal level, we're already in home sales back to the worst part of the last recession. Could this bottom out from here? Yeah, it could. People have to feel comfortable going out and walking through a bunch of houses to shop, and that's probably one of the lags, as well as just ability to buy. But you'll notice they're off by a third, but that leaves the other 2/3 still occurring. So there are homes being sold, and there are cars being bought. And we know that credit risk is not a constant. This graph comes out of the mortgage study that we did that's publicly available. We can send you a copy if you don't have it. This was related to our CECL analysis. And so looking at Fannie Mae, Freddie Mac data through the last crisis, and I have to point out, Fannie and Freddie cleaned their data. After the crisis, they went back and took out all the loans that would not have conformed to policy today. Still, there was a big variation in credit quality, right? And so what this is telling us is that there is a credit cycle, which our own prior analysis has proven that much of that credit cycle is driven by consumer demand, and that when times are easy, you get riskier demand. When times are tough, there's a positive selection possible in those requests to buy new cars and new homes because they see great low interest rates, great deals, at least on cars. I don't know how much home prices have come down. I don't think much yet, but again, that data is not being updated very fast. And so this is a situation where a new auto or a new home purchase, a first mortgage type purchase, may be a good opportunity. Now you still have to verify employment. You really ought to look at cash flow, make sure they can afford what they're doing. But by coming and asking for a loan today, they're telling you that they think they're in a good situation because consumers worried about their own finances don't buy when they're worried about the economy. That's what we have seen through several prior recessions. Now, other types of loans, maybe not. A cash out refi, a personal loan, there are lots of loan types which are, I need the cash and I'm going to give you my assets in order to get some cash to get through. They're sending you the opposite message. So this is not one answer fits all. This is product by product and probably segment by segment, but it's worth asking that question. What are the consumers telling you about themselves from either an adverse selection or a positive selection perspective? Okay. Those are my prepared remarks. I appreciate you staying with me. Now, we do have time for some questions. And, if that was thorough and complete, that's great, but certainly happy to hang around and answer questions. I will say while we fill the time here, just want to give people a chance in case they're thinking up or typing up their question, that we're going to keep doing these updates because things change quickly. And so probably in about another month, we'll come back and do another update both on the virus, on the economy, on the economic scenarios, and what we're seeing. and try to expand each time a little bit of what we're talking about. So we hope to see more there. Question about, will the presentation be available? Yep, I should have mentioned, this is being recorded. The recording is available, and I don't remember if we post the slides separately from the recording, but we'll make sure one way or another that it's all available. And another question here. What are your thoughts on how the foreclosure stresses may impact the servicing business for major players and the potential for large volumes of distressed assets and residential properties coming to market? It is an interesting question. The housing supply, I just looked at this, housing supply has skyrocketed because we haven't been selling the volume that we normally would. And there's always a certain amount of new home construction out there. So part of the question here, I'm thinking backwards from house prices. If there's more supply than demand for a while, then that could happen. That could impact things, that we could see a sag in house prices. And yet, you know, people need to have some place to live. So it's not clear to me yet what the failure rate is going to be on mortgages, just because I'm thinking through all the assistance and forbearance. And if anything, I think forbearance on mortgages is going to be greater than any other category. So will there be an impact? There has to be. Yeah, there's going to have to be mortgage defaults and those foreclosures, and that will, of course, impact the servicing businesses. So, when you talk about large volumes of distressed assets, I don't think this is the last recession. In the last recession, where we had a lot of speculation and we had a lot of a house price bubble, really, this is not so much a house price bubble as a market imbalance between supply and demand that will probably self-cure as soon as we get into the recovery process. So I'm not seeing this as a replay of 2009, but there will be a cost, no doubt. So that's a half a dozen kind of answer for you. Another question here. Do we think historic correlations between macroeconomic factors like unemployment rate, GDP, house prices will hold up during the COVID shock and then later during the recovery? That is an excellent question, because I think the answer is no. I think this is one of the hardest things right now, is that these economic factors have gone in different directions than what they normally would. And the reason they've gone in different directions is because of that selective government assistance. And we haven't seen the end of that. So we don't know anytime the government tries to help, it's going to be selective. There's no such thing as universal assistance. And there will always be winners and losers when the government sends out money. And so those winners and losers affect these metrics we're looking at, that unemployment, GDP, and house prices. Right now, we've already got a disconnect between unemployment and house prices compared to what we've had in the past. And we may, because of this realignment of commercial real estate, we may see that in a long-term depression compared to unemployment and other things. I don't know. But a lot of those historic correlations, I think, are going to break. How do you deal with that? I'll tell you right now, we are rapidly recreating our models, but not for our econometric models, but probably not for the reason you think. It's not to use the most recent economic data, because we don't have an outcome to go with it. Like with call report data, I don't have the quarterly reports to show me what those correlations are. What we're doing is creating ensembles that usually, if you've got 10 years of economic history and loan performance data, or 10 isn't even enough, let's say 15 gets you back through the last recession, 20 gets you 2 recessions. If you build one model off of that data, kind of in a regression style, at best you're going to have 3 economic factors in it. That means you've missed something that's going to be correlated in a different way. And so what we're doing is going back and making ensembles of economic models. Now, we've been thinking about doing this for literally since I started. I started in the machine learning area 25 years ago, and we always knew that ensemble models would be better, but validators weren't comfortable with that, auditors, because machine learning and ensemble modeling was such a new thing. But today, I don't think there's a choice. I think you need more than one econometric model looking at different economic factors so that you can average through some of the wild divergences that's happening in these correlations, and so that you pick up on factors that you might have missed before because you just didn't have the data to see it. So that's my recommendation there. Okay, these were some excellent questions. I appreciate them. Oh, I got to scroll. What percentage of forbearances are still making full payments is another question, and across product categories. Now, I don't have all the answers here. I've heard anecdotes of, well, let me make sure I interpret this right. I'm not aware of the percentage of people who are in forbearance but still making payment. I think a lot of them are hoarding cash rather than making the payment. But I've heard, like in certain unsecured portfolios of cure rates after forbearance as high as 70%. And I think whatever your historic cure rate would be from some kind of a forbearance program, and you can look at things like there's a forbearance program for assisting military families and things like that. What's the cure rate after that? It seems that right now, at least, cure rates are higher than what you've experienced in the past. But I don't have the statistics across products. I'm sorry. Just going to have to see and be aware that, whatever you're used to, at least initially, it's probably higher because we know people are hoarding cash. Now, when they work through that cash, we'll see what comes next. Okay. I'm not seeing more questions right now. I appreciate, honestly, we're still 90% of the folks have stayed with us through this, and I appreciate your interest and attention and kind comments. So good luck and stay safe, and I hope your friends and neighbors do too. And we will talk again soon.